Hello, and welcome to Fund in Focus, brought to you by Livewire Markets. I'm Hansley, and joining me today is Mark Power, the head of income credit at Qualitas. We're going to be discussing the Qualitas Real Estate Income Fund, which is available on the ASX under the ticker code QRI. Welcome, sir. Nice to have you with us.
Delighted to be here, Hans.
So, in case for anybody who doesn't know, tell us a little bit about the Qualitas Real Estate Income Fund and some of the key benefits that you offer.
The Qualitas Real Estate Income Fund was set up back in 2018, and it was set up to essentially what I like to describe as democratising private real estate credit for retail and wholesale investors. So prior to the establishment of the fund, that particular asset class was really the domain of large institutional investors. So what the fund's actually doing, it houses a portfolio of loans to commercial borrowers, essentially for the purpose of real estate development and investment. Importantly, it's listed on the ASX. It's comprised within the ASX 300 and ASX 300 A-REIT indices. And it was set up really with two key objectives in mind. So the first objective is all about providing regular monthly distributions through to its investors, which I'm pleased to report it has done ever since inception. To give you an idea on the sort of returns that the fund has actually generated. So over the last 12 months, the net distribution through to investors has been at 8.69% for the year. And once again, those distributions have been payable monthly. The second key objective is around the strong capital preservation characteristics that private real estate credit can actually have. So if you look at QRI, in terms of its unit price, the NAV, net asset value, has remained at or above $1.60 the whole way through. So there's been no impairment of capital or impairment of income over that period. And part of the reason why it does have strong characteristics around capital preservation is that you've always got this equity buffer ahead of you because you're investing in the debt stack. So you need a very, very significant pullback in asset values before it actually starts impacting upon that debt part of the capital stack, because that actually gets first claims on cash flow and first claims on value in a realisation scenario.
Okay, excellent. So, whenever I hear private credit, I always ask this question, right? There's been this huge rush of flows and interest into private credit over the last couple of years especially. What has been driving that? And I guess I'm asking this to you as somebody who sits at the coalface. What drives that? And is it all just the rise in interest rates?
So it's partly a rise in interest rates, but it's certainly not all that. There are other factors at play. I mean, if you look at it sort of from a very high level, it's essentially the returns that are able to be generated in private credit are really attractive. And that's resulted in a very significant amount of capital coming into the space. And the reason those returns are attractive, I'd say it's twofold. One, it's the whole higher for longer interest rate environment, because essentially the fund and what it's designed to do, it's providing loans to borrowers, and those loans are priced off a margin, a risk margin, over and above the 90-day bank bill swap rate, which is essentially a floating rate. So as rates have remained higher, that's meant that the returns through to investors have been able to be passed through at that higher level. But it's not just an interest rate story, because those returns are actually the function of a really strong macro structural tailwind, essentially, in terms of the way real estate is actually funded in this country. So if you go back 10 years, and the banks actually dominated this sector. So their market share was circa 88% or thereabouts. Now, due primarily to regulatory reasons, they've been acceding market share on a year-by-year basis in a market that's actually growing. So their market share is now back to about 72, 73%, which has created a real capital gap in the market. So what we do as a private lender, we're looking for those opportunities that fall just outside that risk framework that the banks are able to operate in these days. And as soon as you fall out of that, what I'd describe as a fairly constrained risk framework, the returns that you can get are exponentially greater for just taking on board a marginal increase in overall risk. And the reason for that is that you've actually got a bit of a capital gap in that part of the market. Once it falls outside the banking market, there's just insufficient liquidity in the sector relative to the amount of demand for that credit, which essentially means attractive returns to investors.
Okay, understood. So, listen, last time you sat down with Livewire, you were discussing a lot about migration and this massive tailwind that Australia was experiencing. We saw how that impacted the residential real estate market, less than 1% vacancy rates in many parts of the country, among them. Now that this tailwind is coming off, how do you expect housing supply to evolve over the next few years?
Yeah, I think it's important when you say that tailwind's coming off, it's important to understand sort of the magnitude of that. So it's coming off an incredibly high base. So if we look at the year to June 23, net overseas migration peaked at 547,000 people. If you look at what it then did in the subsequent year to June 24, it came back to 446,000. That's still a massive number. If you compare that to the level of net overseas migration in the 10 years prior to the pandemic, that was averaging 217,000. So even in the last year just gone, it's still double the historical average. So essentially, whilst it's come off at an incredibly strong run rate, it's still running at a very, very solid level, which is continuing to create really strong demand for housing and will continue to do so in the foreseeable future.
Okay, so that's the feasibility side, but I kind of want to draw a little bit of what you were saying about Southeast Queensland particularly a little bit ago. We have seen elevated builder insolvencies in the market. It's certainly occupied a few front pages as well. With that particular backdrop in terms of less firms and less people on the ground to actually build the projects, are you doing anything differently to manage the fund and manage those risks?
Firstly, QRI isn't really a construction fund. We sort of fund on the pre-construction. We fund at the back end on completed product as well, and more investment style assets. But having said that, there's certainly been an elevated level of construction risk in the system over the course of the past 3 years. So within our business, we've always been heavily focused on construction risk, builder risk. We're hyper-focused on that and have been for the past few years to make sure that the builders that are on the projects that we're actually funding, and we don't lend to builders, we lend to the developers, and the relationship is in between the developer and the builder. But it's still important, obviously, for the delivery of the project. But we've got a hyper-focus in terms of our due diligence in making sure that the borrower, not just from the builder, not just from a historical point of view, but looking forward on their order book and how they're structured, and they've got the capability and the experience and the financial strength to actually see the project through. So we are doing that on the construction side. More broadly on the income credit side, it's pretty much business as usual for us in terms of our whole risk underwriting process and asset management process, which is incredibly rigorous. It's placed us in really good stead. It's one of the reasons why, notwithstanding there's a bit of noise out there in the market, we're really comfortable with the current health of our book. We've got no impairments, we've got no arrears. In fact, within QRI, we've never had an impairment of capital or an impairment of income across the entire journey from 2018. And if you actually wind back further, you go back 16 years to the creation of Qualitas, across our credit strategies, we haven't had any impairments of capital or income.
Okay, well, it's all good to know. It's all important to know in this climate too. So just to wrap things up, for investors out there who haven't added private credit to their portfolio, why should they consider the Qualitas Real Estate Income Fund specifically?
Firstly, it's about providing that regular monthly distribution through to investors in a portfolio which is fairly moderately positioned from a risk perspective. I think that's the first point I'd raise. Also, it's really important if investors are thinking about coming into private real estate credit or private credit more broadly, make sure they're investing with a manager with a deep level of experience in the industry. So we've been around for 16 years. We specialise purely in real estate. So some other private lenders will do real estate, they'll do corporate lending, there'll be a bit of jack of all trades. For us, that's not the way we want to go. For us, we specialise purely in real estate. That's what we know, and that's where we think we can get the optimal returns for investors relative to the risk that we're being asked to absorb. And that's not to say there isn't any sort of risk in private real estate lending. There is, obviously, in terms of the nature of what you're doing. But it's really important that you're with a manager that knows how to properly manage those risks. And the last point I'd raise is that one of the key benefits of QRI is that it's listed and it's got strong levels of liquidity. So an investor wants to get in and out of their investment, they can do that with relative ease, as compared to an unlisted closed-end fund, which hasn't got the same liquidity characteristics associated with it.
Okay, that's all good stuff to know. Mark Power of Qualitas, thanks very much for joining us.
It's been a pleasure, Hans. Thank you.
And thank you for joining us. If you enjoyed that interview, you can subscribe to the Livewire Markets website, as well as our YouTube channel, where you can find more funds in focus. Until I see you next, take care and thank you for watching.